Good morning. How are we all doing? How's the sound? Does the sound okay? Can you hear us okay? Well, we started off, it was a little bit too quick, but we started off with a thunder sound, a thing of war and flags, and the reason we did that is because, in case you don't know, there's a trade war going on. And I can't tell you how many times I was asked, oh, you're talking about the trade war? You're talking about trade war? Yes, we'll talk about the trade war. We did not make it part of the presentation because the presentation is done about 2 weeks prior, so we had to add this in at the last minute on what we're going to talk about. So we don't have any slides, but we are going to discuss the trade war here for a few minutes. Is there anybody concerned on the trade war? All right, let's go home. Well, it kind of makes this pointless then, because on the front of Barron's today, they're saying what we've been saying right along: keep calm. Keep calm. There's so many good things that are going on with the United States that you don't need to worry about the trade war. We got things like today came out that the GDP for the U.S. about $21.2 trillion. The imports from China, they're about 2.4%, very small amount. China's GDP is about 13.7 trillion. For them, it's about 3.7, almost 4% of their GDP. So it affects them a lot more than it affects us.
And really the only thing that could bring us down in a trade war is if consumers start to get worried about it. And again, there's nothing really to be worried about. We look at the impact of the tariffs, again, very small in terms of scope. And we're looking at, it's not all going to flow through to the consumer. And I want to be clear, of course, we're not advocates of, yes, the trade war is great for the economy. That's not true, but it's necessary from our point of view. And it's not going to take down the consumer. Companies are going to take some of that effect. I mean, you looked at like Apple, they're going to be impacted by the trade war. If they take on some of that, it's going to impact their margin, but they're not just going to say, well, sorry guys, we're going to pass through the entire cost to you guys. That's going to hurt their sales in the long term. So there's going to be a balance between maybe China suppliers taking on some of it, the businesses here in the United States taking on some of it, and then the consumer, again, will have a slight increase in price. But if you're buying a t-shirt, let's say for $20, all of a sudden it's $22, any really big difference there? You're going to say, wait a minute, I bought a t-shirt last week, now it's $2 more, I'm not doing that.
Yeah, it's so funny. People think, oh, you don't remember what you paid for a t-shirt or a pair of pants like 2 months ago, 3 months ago, and they're so concerned about the consumer not spending. You don't remember that stuff. But other important factors as well that could help is that the yuan, which is the Chinese currency, that could go down, the US dollar could go up, making their products more cheaper for us. Also, too, we kind of looked at, again, GDP is about $21.2 trillion. If all the tariffs were affected, it'd be about $525 billion about what we worked out. How does that compare to 21 plus $2 trillion? It's not material, so there's no reason to get upset about it. Also, too, last week we had the CPI come out. CPI showed that apparel and home furnishings actually were declining. Well, wait a minute, we have 10% tariffs. I thought they were increasing. Didn't happen.
Yeah, and the point of view, we believe that the United States will win this trade war. Very confident on it. China's coming out, you know, they're a communist country again, and their government-based papers are like, we know we will stay strong and all this stuff, but based off of what we're seeing, they're running out of options to retaliate against us. We've seen them increase tariffs on our products. Really, the only things that they could do to retaliate, they could dump our U.S. treasuries. They are a large holder of it. But if you look at the percentage, what is it? They have $1.1 trillion of...
Yeah, I was going to say that they're not that large. They used to be back around 2012. They did hold about 12% of our debt. It is now down to 7% is where it stands now. So not the big factor, the big scare it used to be. It is about $1.2 trillion. But right behind them, people don't realize, Japan owns $1.08 trillion. So it's not that big fear. You know what? China, if you want to take your money, go ahead. Where are you going to put it? 10-year boon from Germany at 0.1%. I don't think they're going to do that. So I think that is safe as well.
Yeah, and also if they did dump, let's say, the treasuries, you would get an increase in interest rates here. It would hurt us a little bit. I'm not going to say it'd be great for us, but it would hurt them a lot more because, again, as we talk about with bonds, as interest rates go up, bond prices go down. So they've put a big flood of bonds onto the market. Those assets are going to depreciate quite quickly for them. Not going to be good for them. It's going to hurt them a heck of a lot more than it's going to hurt us. And then, as you kind of said, another thing that they could do is potentially devalue their yuan, which would be beneficial to the consumers. It wouldn't have a big impact on the tariffs. But if you're looking at that from a government standpoint for China, you risk capital flight. So you risk companies moving their assets out of China. They don't want to devalue their currency too much. It makes them look very, very weak.
And also, too, the whole reason for tariffs is to stop buying those products there. And what's actually happening, what the U.S. is doing, actually, Sonoma, what was her name?
Sonoma Williams, yeah, or Williams Sonoma.
Yeah, CEO mentioned that, hey, they're moving their products, their manufacturing back here. They can also go to Vietnam, to Thailand, to Philippines. We don't need China. China's income, I mean, their wages have actually doubled over the last 10 years. So China, they're not in a good position. Their economy is actually slowing down. Ours is doing very well. So China's going to realize that, and China's also rapidly increasing their debt. And they're talking about doing it more, it's going to hurt them. So the United States is very strong, our economy is very strong. No one's worried about it, but now you have reasons. When someone says to you, oh my gosh, it's going to be bad, you now have reasons. I saw you all take notes and write these down so you can share them, right? So, all right. One other thing we do want to talk about, because we got calls on that, was, gee, Brent, you just bought Apple, and then you turn around, you sell it, I think 2 months later. What's going on with that? Well, Apple again.
Well, I can tell you what happened. We used our crystal ball.
Yeah.
And target sell price was right there, so it's time to get out.
You know, we need to bring that every client event. We'll put it right in the center so we can look into it for you, let you know what's going on. It actually is. Those, I think everybody's been in the office. We actually do have the crystal ball in the office.
It doesn't work, though. I don't want to lead you on. We're still figuring it out.
But when it doesn't work, we fall back on the fundamentals. And what happened was that Apple did hit the target sell price around 212, 213,
214, I believe is where we exited.
We saw that. So again, no emotion, just results. We sold the company. It has fallen since then. We were also concerned on their business model because they're going to be slow to the market with the 5G, and while they have all these services coming on, the problem is if you don't have your phones there as many, because I do believe, I don't know about you, Chase, but I do believe that there will be people that as much as we like the iPhone, they're going to want that faster speed of 5G. They're going to flip over to maybe Samsung.
Yeah, and I think their battle with Qualcomm really showed how weak Apple is in the 5G sector, because they're coming out saying, yeah, we're going to be very strong against Qualcomm. The morning of the trial, all of a sudden, they reach a deal, and I don't think they got much out of the deal. I think Qualcomm was definitely the bigger benefactor there, and I think it really showed that Apple was like, we need 5G because we're going to fall behind competitors if we don't. And I think Samsung does have the leg up on that. Yeah. We'll have to see that. That's a big concern of ours. And again, you talk about the services. If you don't have that iPhone, you can't generate service revenue. You need the iPhone to generate service revenue. So I think it was about, I'm happy we got out of Apple when we did.
Yeah. And again, I think Apple's a great company. I have an iPhone in my pocket. Great company, but again, as investors, we have to look at the value of what we pay for something. If we think it's overvalued, we will sell out, sometimes too early, sometimes too late, but that's what we look at, and again, no emotion, just results. So.
And it can't be top dog forever. I always joke about, my younger brother Nash is here if you saw him on the way in, but I always say Nokia used to be the top dog in phones. Remember Nokia? Yeah. I mean, they're not really a big player in the phones anymore, so.
Yeah. All right, so that covers the trade war for you, it covers Apple for you. We're now going to get on to the regular presentation. Coming up, we're going to have Harrison talk. Do you have a question? No?
No.
Okay, Harrison talk. He showed this to me. I got so excited. I stood up and I started jumping when I saw this. I could not believe these numbers he put together. So glue to your seats. Stay tuned because it's going to be great. Harrison, he's our CFP, our financial planner. Come on up.
All right.
All right. So who here by raise of hands is concerned about paying taxes? Who's paying too much in taxes? A lot of hands here. Okay. So I'm going to try and break down what taxes are going to look like in retirement. A lot of us are getting, well, not me, but you guys out there are getting close to retirement or in retirement. So I'm going to break down, there we go, now I'm on. I'm going to break down what you hear in the media. Maybe you see articles, CNBC, Yahoo Finance. There's a lot of information about taxes in retirement and how scary it is. So here's some of the stuff you hear. Well, number one, California has the highest state taxes in the nation, 13.3%. That is true. However, yeah, boo, right? Now, in order to get charged 13.3%, you do have to have taxable income over $1 million. That's not most of us. So again, they're high taxes here, but it is a bracketed system, so the more you make, then the higher taxes you get charged there. There are actually 8 states in the country that have a flat tax, and so in those states, for lower income people actually pay more taxes on the state side. So it all comes down to just the understanding of it. Something else we hear, well, when you retire, Social Security is going to start. You're going to have to start taking RMDs. You're going to withdraw from your IRAs. You're going to have multiple income sources coming in, and that's going to lead to more taxation. Sounds scary. This one I hear a lot. You know what? I'm moving out of California. Damn it, I can't stand these taxes anymore. I'm just getting out of here. That's something I hear quite a bit. And I think there's just a consensus out there that people believe taxes are going to increase in retirement. So let's look at some of the facts. Well, number one, when you retire, you no longer have to pay FICA tax. For those who don't know, FICA tax is 7.65% of all earned income that you make. So when you have a job that's earned income, whether you're self-employed or whatever, you have to automatically pay 7.65% of that to cover Social Security and Medicare. So on $100,000 of income through W-2 wages, you have to pay $7,600 to the government right off the top before you pay your federal and state income taxes, all right? In retirement, that goes away. Number two, on the federal side, we had our standard deduction increase to $24,000 last year with the new tax changes. This year, that's increased to $24,400, just inflationary increases that happens every single year. But also, if you're 65 or older, you get an additional boost on your standard deduction. So if you're married and both you and your spouse are 65 or older in retirement, you both get to add another $1,300 to your standard deduction. So that actually increases it up to $27,000 on the federal side. So that's pretty cool. On the state side, on the state side, if you're also 65 or older, you get additional credits. So you and your spouse, additional $118 credit on the state side. So what's the difference between a credit and a deduction? Well, if you have $118 credit, that will reduce your taxes by $118, period. If you have a $118 deduction, that might only decrease your taxes by $20, $30, $40, depending on whatever your marginal rate is. So again, more deductions on the federal side, more credits on the state side, just for being 65 or older. So that's pretty cool. Something else, Social Security on the federal side, there's a lot of confusion about how this is actually taxed. Now listen to what I'm saying here. On the federal side, somewhere between 0 and 85% of what you receive on Social Security is actually countable as income. That's also the same as saying that somewhere between 15% and 100% of it is tax-free on the federal side, all right? So to make the math simple, let's say you get $100 from Social Security. The most you're gonna have to tell the IRS that you made from it is $85. But in a lot of cases, it's actually much lower than that. So that's a positive on the federal side. On the state side, California does not tax Social Security benefits. So if you're shifting from wages and then to Social Security, your tax bill is going to go down quite a bit because it's not taxed the same as regular wages are, all right? So let's look at an example. We've got a couple here with $100,000 of W-2 income, and this is before they retire, all right? So if we break this down, as I said, first they have to pay FICA, right? So that's 7.65% of all earned income. So there's your $7,650 there. Then if we go to the federal side, after taking away the standard deduction, putting it through the brackets, you got close to $8,700 in taxes on the federal side. And then on the state side, start at 100, take away your deductions, take away your credits, you're left with about $2,500 on the state side there. Again, this is pre-retirement. So you're paying close to $19,000 to some government agency, whether Medicare, Social Security, Medicare, federal, state, government's taking those taxes from you, all right? Now, if we shift gears into retirement, let's look at that. Now, I want to point this out. We still have $100,000 of income, right? It's just coming in different sources. Now, we've got 42, right there, coming from Social Security. 33,000 we're going to withdraw from an IRA. So you've got an IRA account, you're going to withdraw $33,000 from there. And then we're going to have a trust account or a taxable account, TOD account, and we're going to withdraw $25,000 from that. This is a hypothetical situation. We still come up with $100,000 of income, but the tax is much different. So, as I mentioned, only part of your Social Security is taxable. We received 42, but we only had to report 29,000 of it. That's about 70%. That just comes out based on the income here. But again, that means you're getting $13,000 for free, tax-free on the federal side, so that's a positive there. IRA, everything that comes out of an IRA is fully taxable, and in a taxable account, the only time you pay taxes on a taxable account is when there's capital gains and dividends. However, with someone with this income structure, they're below the taxable income amount where you pay 0% on capital gains and dividends, all right? So on the federal side, when it's all said and done, we're only paying $3,800 in taxes compared to the $8,700 we were paying before on the same amount of income. On the state side, I think this is going to be surprising for a lot of you. Again, $100,000 of income. Well, number one, Social Security, that's all tax-free according to California. We've got $33,000 in income over in the corner from your IRA, and the state of California does not recognize capital gains and dividends, so it's just counted as regular income. So an account that's paying out $25,000 probably has capital gains and dividends around that amount, so that gives our California adjusted gross income a little over $50,000. However, both you and your spouse are 65 or older. After taking those credits, taking the deductions, and going through the brackets, you come up with $0 on the California tax side. 0. Now, this was no accident, all right? In order to be in a situation like this where you actually pay relatively low taxes, you have to plan for that ahead of time. They didn't just decide to turn 65 or retire and not pay any taxes, but if you plan it out and structure it, you can look at a serious reduction in your taxes in retirement, all right? Anybody think that you could get $100,000 and not pay anything to California? That's pretty exciting there. So again, that's where the planning portion comes place. If you are paying taxes, maybe you should come talk to me. I mean, I've seen a lot of you out there, but I also haven't seen that many of you. So if you want to learn about it, come and talk to me. It's all right. Hand it back over to Brenton Chase here.
All righty. Thank you, Harrison. You know, when I first saw this, I was surprised because, like, everybody says, I got to leave California when I retire. I'm thinking, holy crap, all these people are making a big mistake thinking they're saving in taxes when they're really not. So, hey, we can all stay in California when you retire. Well, even now.
I want to be clear, too, we're not advocating for higher taxes. We're just pointing out a situation here.
So again, it's very exciting. And again, Harrison, he does do the financial plan because we do the investment part, Chase and I did realize a few years ago, people wanted to have a financial planner kind of pull all this together and look at things like that for you. So we do free consultations for him, so you can come in and say, hey, I want to talk to Harrison. He'll show you a lot of fun things like that to help you out and do better on your overall financial plan. All right, let's switch to the investment side here. Would you fire Warren Buffett? We brought this one up because people say, oh my gosh, it's been a year, it's been 2 years, I've only done this, or you haven't beat the S&P 500, what is wrong with you? We brought up some facts here. Would you fire Warren Buffett? No one would. If Warren Buffett said, hey, I'm going to manage your money for you, who would say no in here? What? No.
Because he got us.
Wait. Because you have Wilson Asset Management. Okay, I like that.
I like the picture, too. He's like, would you fire me? I don't know.
But he's underperformed the market on an annual basis 50% of the time.
Yeah, and then underperformed the market 25%, so a quarter of the time, over a 5-year period. So it's like, gee, Brent, Chase, I've been with you guys for 5 years. You're trailing the S&P. I'm going to do index investing.
And then the third one is over 10 years. Now, you would kind of shocked when we saw this. 10% of the time, he doesn't outperform the S&P 500 either. But
when you look at Buffett's outperformance from 1988 to 2019, he's outperformed the S&P 500 by 350%. But again, if you're looking at a 2-year time frame, a 3-year time frame, in the grand scheme of things, that's not that much time. We're talking about investing your money for a lifetime. That's why we stick to our philosophy that Warren Buffett's used of value investing. It works over the longer term, you just have to give it the time. And that's why we always tell our clients, it's not just about performance. You have to understand what we're doing behind the scenes. You have to understand why we stick to value investing. The reason is, it works. You just have to be patient.
Yeah, doesn't always work in the short term, does work in the long term, and that's why we're always managing money. If I have the clients in here, I know I have some in here who've been with me 20, 25, 30 years. Actually, I think I saw the Hoaxmas, you've been with me, I think the longest, like 30 some years. And again, that's what we always look at, is how we're going to do long term, not what we're going to do next week, next month, or even next year. Because people now, you're living at, what, 85, you know, so that's what we're kind of looking at. And it doesn't always look good. but that's where we kind of look at. So again,
I was going to say, does that surprise you, though, that Warren Buffett, the greatest investor of all time, on an annual basis, did not beat the S&P 50% of the time?
we were very surprised.
I was shocked by that, yeah.
All right, why we don't buy IPOs. This is one of the biggest years, if not the biggest year, for IPOs coming out. People saying, I've been on TV talking about, Uber and this and so forth. We don't buy IPOs. Why not? Well, first off, what is an IPO? It stands for Initial Public Offering, and this is when a company generally wants to raise capital to bring money in as opposed to keeping it all tied up.
And when we look at the IPOs, a lot of people get very sucked into the hype. It's so exciting, right? But oftentimes the gains are not as big as they appear. So there's a difference between the opening price and the IPO price. So a great example of this was Lyft. A lot of people were excited about the Lyft IPO. The IPO price is what the company actually received in funds. That IPO price was about $72 a share. But what happened is when it hit the market, when normal people, not the insiders or employees, could actually buy into Lyft, it was $87 a share. So if you wanted to buy it on the open market, your first buy opportunity was at $87 a share, not the IPO price of $72. So you see that big jump up? That's not people in the stock market. That was people that are employees or founders of the company that get that benefit.
And the other thing that's changed a lot too over the years, that used to be you got an IPO, like in the very beginning and so forth, they had a lot of potential gain. What's happening now, a lot of these IPO companies are staying private longer. They're getting a lot of private equity to come into them. So when they do go public, there's not as much gain there because they've been private for so long. So IPOs are not the great deal that, I'll say that loosely, that they've been before, because things are changing in the IPO market.
Yeah, and again, kind of just addressing why we don't like the IPOs is, Brent alluded to the fact that they've stayed private. When they're private, you don't get the same type of information that you do with a public company. We like that information. We know it's very sound, so we'd rather wait, say, at least a year, so we have a year of good information as a public company before we get into it. And it's very exciting to get sucked into the hype, but again, I'll bring up Lyft. They're at about $87 a share on that opening trade. I think they're now around 54.
52, I think, 54 maybe.
$54 a share. Uber, another one. This was very surprising. Their IPO price was 45. First trade was actually 42. Very rare that a big IPO like that opens low. I think that's very concerning for the market, or not the market, but for Uber over the long term.
And actually, I did do what did I do the segment on it? I forget where it was, but actually, I actually talked about it. I don't think that, I think it was One American News Network, I don't think that they'll ever make a profit. And they try to compare themselves to Facebook and Amazon. I'm sorry, they're not the same as those two, so don't be fooled by Uber.
And other things we're concerned about is, where do the proceeds go from the IPO? If you look at it, we want to see the proceeds go to actually growing the business, making sure they're investing in research and development, maybe investing in operations, maybe marketing. Sometimes that's not the case.
Yeah, a lot of times what it ends up doing is you got all these guys that were there, and a lot of investors got in on the early part. The money comes in, it actually goes to them. It doesn't go back to the company. I think there was one company, about 80% of the money went to the investors, and only 20% to the company. So that's not a good thing. And the other thing, too, that we don't like is be careful of the voting rights. They got things called super voting and some other things that not a good thing.
Yeah, it's very important to understand the voting. I'm going to pick on my favorite company here, Tesla, a little bit.
Ooh.
Like Elon Musk, for example, he says, I can do whatever I want as CEO because he essentially owns all the voting rights. If he wants to call a meeting to the board, he owns about 50% of the company, so he could come in and say, oh, let's put this up for a vote. Yep, I win, and you take it over. What's happened now, too, though, is like companies like, I think it was actually Levi, or was it Levi, or there's a company that came out that they have, again, the super voting share. So what happens is you get 10 votes per one share. So that really concentrates the voting power at the top. So again, they have way too much power, where it's not a true public company, which can be very, very dangerous because they could be going down a bad path. And as a shareholder, you have a right to come in and say, I don't like that path they're going down, and actually bring that up to the board.
And how that can affect, and again, with voting, people say, Brent, how should we vote? I always say follow the board of directors. I believe it was Allstate. We did send out an email blast to people that have Allstate, said, we do not recommend voting for. They want to have the right to not tell you where their political money is going. I think that's a wrong thing to do. I think they should not be in the political game. They should not be doing that. If they do that, they should let you know first. So we do let you know on that. But again, if you have the 10-1, they could, sorry, we don't care what you say. We're going to do it anyways. Don't like that at all. All right, let's pick up the pace a little bit. Oh, by the way, are Kansas stocks going up in smoke? The brownies and those muffins you're eating, they're all filled with cannabis. No, just kidding.
That's why you're feeling a little fuzzy.
That's why you feel pretty good.
Just kidding. We would never do that, of
We
course.
wouldn't do that to you. But again, this is also in the news. Oh, we got to buy cannabis stocks and so forth. Well, understand how the companies are listed. I mean, most of them are
Yeah, I mean, if you look at it, what happens is because, again, marijuana is still illegal at the federal level. So what that means is if you are a U.S. operating cannabis company, you cannot list on the New York Stock Exchange. The big cannabis companies that you see, like, gosh, what's the...
MedMen?
Not MedMen, because I wanted the Canadian companies. So Aurora Cannabis, Canopy
Tilray.
Growth, Tilray.
Yeah.
Those are all Canadian-based. They don't have any U.S. operations at this time. That's why they can list on the New York Stock Exchange. MedMen, who we'll dive into in a little bit, they actually have to list on the OTC market, the pink sheets, and they could list on the Canadian Stock Exchange. They cannot list on the New York Stock Exchange.
Right. And one thing about the Canadian Stock Exchange is it has less stringent regulations than we have the New York Stock Exchange. And we saw one company, do you remember the name of the company? It was
a smaller cannabis company, but
one of the, I think it was board of directors or one of the executives.
The CEO.
What's that? The CEO. He got what was it, arrested? He had a history of
insider trading.
Insider trading. And this is the guy who ran this cannabis company. So when they're listed in Canada, they don't have the strong rules to protect you like we do here. And all of a sudden, things like that are going to come out, and oops, the stock's going to drop.
Yeah, so you got to be cautious of that. That's the main reason we don't like them. And there's just not a lot of information on it. Plus, you can see here, it's just a weed.
And this is one thing that just amazes me. It is a weed. You can grow it in your backyard. It's not that hard. And what we always talk about, barriers to entry. Well, everybody's getting so excited about this. There's no barriers to entry. It's not like if you want to have, distill wine or beer, it takes a lot. You can plant the seeds in there, and oh my gosh, you got pot in your backyard in, I don't know, 3-4 months. I'm not a farmer, but there's no barriers to entry. So all this hype about the cannabis world and so forth, the supply will be unlimited, and high supply will hurt that because if the demand doesn't surpass the supply, prices will come down. So we're very scared of the cannabis ones. And an inside look at a cannabis company, large cannabis company?
Yeah, so that's where we're going to take a look at MedMen, because MedMen is actually one of the biggest ones in California. So you might be driving around town and see MedMen and think, wow, they must really be blown up. They must be really doing very well as a company. That's not really the case. As I said, there's not a ton of information out there that I really trust yet because they aren't filed on the New York Stock Exchange, but they still have to release information. They actually lost $130 million in the last 6 months of 2018. For reference, that's about $2 lost for every dollar of sales in cannabis. That doesn't really seem like a sustainable business model. They only had about $80 million of cash on the balance sheet at the end of last year. Well, they had to raise new funds. Problem is, with that type of business model, not making much money, banks don't really like to lend to you. The only way they got a rate or a loan was it was 6% plus LIBOR. And LIBOR, again, is a variable rate, so it's going to move up and down. Not a very good interest rate. I don't know how they're going to pay it back. I think a lot of these cannabis companies are going to have very, very big problems. I think a few of them might be around in the future and could be very good, but we don't know which ones are going to make it. That's why we're staying out of it.
Yeah, and one thing that they're doing right now is because there's regulations and like you can only get like licenses in California. I think it's Oregon. It doesn't work there because anybody can do it if they want to. So if those regulations go away to where the state says, oh, anybody can have a cannabis company, you're going to see pot just fall apart and so forth.
Because you have a lot of like companies that are staying out of Oregon and Colorado because it's not profitable. You can't make money. As you said, it's just a weed. There's so much supply there that it's just not profitable.
Yeah, and the Fed could come in and say, okay, we're going to take it over now. You want to do a pot company? Go ahead and do it. That would really cause problems for those people that have the pot companies. A lot of them probably wouldn't go under. And if you want to read more on the MedMen, when did we do that newsletter? It was like a month or two ago?
Yeah, it was about a month or two ago.
Yeah,
and I
just
just
go to our website.
One more thing, too, that really hurts with the supply is the illicit market. It's very hard for people to crack down on illegal drug sales, and MedMen's been trying to get people that weren't previous pot smokers to become pot smokers. Hasn't really worked out for them. And then also the people that do smoke pot, they're going in there saying, wait a minute, my drug dealer over here can get it to me, I don't know how much pot goes for, I can get it for $10 an ounce, but over here at the regulated, highly taxed dispensaries, it's about twice the price. So a lot of the people that know the pricing, they're not going to the dispensaries, and the people that didn't smoke pot in the past, they're not going to the dispensary. So it's been hard to get that demand driven
Yep.
into the cannabis industry.
Again, no barriers to entry is the problem.
So partners,
All right.
we hate it. We don't like cannabis stocks.
Yeah.
We will not be buying.
You will not see cannabis stock in your portfolio. All right, adult children threatening parents' retirement. Just stop. You know, don't threaten my retirement. $500 billion a year spent on children from ages 18 to 34. This is hurting a lot of people that are in their 50s because they're trying to save for retirement, but yet the 18 to 34-year-old kids are still draining them, and it's going to be hard to retire. It may delay your retirement from 65 to maybe 75 because your kids took it away from you. And again, you lose the compounding effect is what actually happens.
Those darn millennials, can't trust them, right?
Yeah, Chase is okay.
I'm just kidding. But, you know, there are ways to, you know, you want to help with generational wealth, and, you know, that's, again, something Harrison works with is, you know, if that's part of your goals, there are ways you can help your kids. I mean, but you have to, again, look at yourself first, because if they drain you, you get to retirement, now they have to fund your retirement. Big problem, doesn't help with generational wealth. One thing we kind of recommend, though, is if you are trying to help your kids, don't buy a house that they can't afford. And of course, you can help with a down payment, but if they can't pay the mortgage, the property taxes, all these other things, that could be a drain on your finances longer term as well.
And you want to be careful about buying the house and becoming the bank. We had one client do this. They bought the house for the children. It's like, oh, that's great. They're going to pay me. Unfortunately, they stopped paying, and they were kind of counting that money for retirement. Well, when your child's in that house, you can't really say, sorry, get out. I mean, I guess you can. It's kind of difficult to do. So you want to help them, but be careful of becoming the bank, because it will put you in a situation that you may not want to be in. So be careful of that.
And then lastly, you got to watch out for gifting laws. There's a lot of course, regulations from the government on what you can't give. Of course, it'd be great if, you know, you're getting older and you could just give everything away, don't have to worry about the taxes and everything, but that's not the case. So you have to, again, understand what the gifting laws are. You'd hate to get a tax bill maybe 5 years after doing some gifting, say, oh shoot, I didn't realize that.
Yep. And these are, again, why we have Harrison as our financial planner to help you through those things we have with the financial plan. You can actually look at that much easier and say you can do this for your children, but be careful because this will cause a tax problem. All right, S&P 500 returns properly understood? No, I don't think they are. What is a market cap weighted index? Well, this is where you have the market cap is the number of shares outstanding multiplied by the share price. So if you have a large market cap of, we'll say, of $100 billion, you're going to account for more of the index than that company that has $1 billion. And so it really distorts what's actually going on.
Yeah, and that's, again, one reason we don't like index investing. And the other thing, too, is we always tell people, I've never seen anybody that puts 100% of their money in the index, so it doesn't really reflect those actual returns. But again, moving forward, I don't think the index is going to do as well. We don't think it's going to do as well. Because if you look at the past, 10 stocks account for a quarter of the 10-year bull market. It includes expensive names like Amazon, Microsoft, Boeing, and Home Depot. Those are all very good companies. They've done very, very well over the last 10 years. Problem is, I don't think they're going to have the same returns over the next 10 years, which could drag down the S&P.
And the index includes expensive companies like Amazon, Microsoft.
I just said that.
I know, but I want to make my point. and Home Depot. And what happens here is that these will actually, they become so much of the index that they will actually be less as they come down. What can happen with these large companies, I don't think they're going to fall dramatically. No. But I think what's going to happen is that they're going to stay about the same. Like Amazon's around $2,000. I think for the next 5-10 years, it could go from $1,800, $2,200. Microsoft did this back in the early 2000s, did it for about 15 years, didn't grow at all. But the earnings had to catch up to the stock price. So I think you're going to see the same thing with these higher priced companies, so be careful of that. What could happen moving forward?
Again, it's probably not going to make as much money in the index just because the heavier weighted companies are very, very expensive. And those lower companies that aren't as much as the index, that's where we're finding the good valuations. Those are the ones that are going to do very well over the next 10 years. And that's why we're not picking the names that are expensive at this time.
Yep. All right, next one. Why we're adding ROA, which stands for return on assets, to our analysis. Because I've done the same analysis for many, many years. The big change was probably, I think before you're here, probably about 10 years ago, where I reduced the amount that we did for our target price from a PE of 20 down to 16.5 because of the fact I looked at the 40-year average and I thought the 20 was too high. We don't want to wait too long and miss the sells. Why we look at return on assets? Well, it's a potential indicator for future write-offs. That's one thing we kind of get worried about, is that write-offs can hurt the value of a company. So now we look at return on assets. We want that return on assets to be at least 5% or greater. And we've not looked at return on assets before.
Yeah, and the big thing that again, talking about index investing is we look at the S&P 500, the companies there, $3.3 trillion worth of goodwill, and we'll get into what that is in just a second. That's about 10% of assets. That means if we have a slowdown in the economy, if something happens with those businesses, they have to take that write down. That's going to hurt their assets, going to hurt the equities of the companies, and really hurt the valuations. But what creates goodwill?
What's that?
So what creates goodwill?
What creates goodwill, and that's the problem, is that when you see a lot of acquisitions going on and so forth, and they pay $10 billion to this company, you take the book value and say the book value is $5 billion, and they actually bought for $10 billion, that's $5 billion of goodwill that's actually on the balance sheet. And there's testing to make sure that stays the same. There's companies that are hurt by it, like Kraft Heinz.
Yeah, and we put this on here because there's a difference between good goodwill and bad goodwill. Kraft Heinz.
Good goodwill.
Yeah, good. Kraft Heinz was bad goodwill. It wasn't a good company. They had poor return on assets. This is why we added return on assets, because if you're not generating income from the goodwill, that's when the write-downs are going to occur. Disney is an example of good goodwill. They acquired Lucasfilms, which is Star Wars. They acquired Pixar. They acquired Marvel, which, of course, have we seen the Avengers yet? I haven't seen it, so don't tell me anything.
No one's
yet.
raising their hand. Has anybody seen the Avengers?
Good.
Very, very low. I saw it, and I'm sorry, I was not impressed by it. I thought it was okay,
Really?
but I think the hype was too big. So
I haven't seen it, but I bring that up because it's generated a lot of money for Disney. It's
Yes.
one of the highest grossing films, if not the highest grossing film.
But we're all smart investors in here, so that's why we don't waste our money on movies.
Exactly. But Disney, we looked at the return on assets, about 8-9 times return on assets. That's very good. We want to see it above 5. That doesn't indicate a high risk for the write-off on the goodwill, which again could be very impactful. Another great example of write-down on goodwill was AOL Time Warner. It was supposed to be the mega deal of the century. But what happened was, I don't even think AOL's around anymore. I don't.
Yeah, they're still around.
They're still around? Okay.
Yeah.
They had to take a $99 billion write-off for the goodwill because they overpaid drastically during that merger. So you just got to be very, very cautious with it. But companies like Tyson Foods, they have goodwill. But again, we look at these synergies. That's why we read the conference calls. You have to make sure that that acquisition is living up to the hype, that they're still able to make money off that acquisition.
And all this is because when we invest, we're buying small pieces of large companies. Had a call today on the radio show. The guy said, "Well, a few weeks ago you said Waste Management was overpriced. Now it's up 10%. We don't care about that short time frame. We're buying businesses that can make you into your retirement feel very comfortable. That's why we spend so much time. And before we buy any business, it's 10, 15, 20 hours of research before we get into that business. And goodwill is something that we have seen can actually hurt companies. I was very surprised that Warren Buffett bought Kraft Heinz when he did it, and now he regrets it. But we've tried to get Disney. It came so close. It was down to what? I think our target buy price was like 95. I think at 96. Darn it, didn't hit it. But I mean, sometimes investing can be very frustrating because you're doing all the right things, but in the short term, it just doesn't work. But long term, it always does work. So, alrighty. I did not ask if the food is ready back there. Is the food ready, Rochelle? We're ready? Okay, yes, 10:45, so that's when we break here. All right, and as you know, if you've been here before, that we release tables. You have a company name on your table there. What we're releasing this time is by net income. Now, when you come in, if you know the businesses, although we change it up on you all the time, you kind of know where to sit so you can go first. Well, today we're talking about net income for the quarter, who had the highest. So if you're at a company with JP Morgan, their net income just for the quarter was $9 billion. TJ, is that you? He is always last. He's always last. And you're, oh, wow. Okay, so you're at JP Morgan, get up and get your food. Alrighty. One thing unique about what we do at Wilson Asset Management is that our money is invested right alongside your money. So one thing that we do is we actually show you where we're investing. Now, this is my portfolio. You can see in my portfolio what I have. Now, if you have your portfolio with you, you'll see it's probably about 90% the same as your portfolio, but we share with you where we're invested, and this is a big part of my net worth. So again, don't think it's like, oh, it's just a $100,000 portfolio. No, it is a big portion of my net worth because this is how I made so much money over the last 10, 20 years by actually investing doing this. So we share that with you So you can see that, yes, if I'm down on XYZ company, well, Brent holds it too, so we're both sharing the pain. But again, we are long-term investors. And then next on the list?
Next is my portfolio, and this is essentially my entire net worth, of course. Other than I do have a savings account at Synchrony Financial and a checking account at JP Morgan Chase. And my other net worth item is I do have a General Motors Chevy Silverado as my truck. So that's my entire net worth, essentially wrapped up in the portfolio in one way or another. But again, you can see my positions here, just like your portfolios.
Yeah, so we do this so that, again, you know that we're not just buying something different for you. And I always tell new people when they come into us, you know, ask the current broker, advisor, whoever you're working with, where's your money invested? If he says, well, it's different than yours with different objectives, I don't know about him, but my objective is for you and myself is to make money on my investments and not take high risk. So that's why we all invest the same way, and we always show you that. And it's very unique in the industry. A lot of brokers say, well, that just doesn't fit me. But we're, again, invested right alongside you as well. So let's get started with the first company, Synchrony Financial. Wow, Synchrony Financial. We own about 411,000 shares, about $14.4 million of this company. Stock price change year to date up 52.9%. I will not make you raise your hand if you called us last year in October and said, please get me out of this company, it is so low. We won't do that to you. But year to date up 52.9%. They were founded back in 2003. They're back in Stamford, Connecticut. What I like about Synchrony Financial, the concerns over Walmart and Sam's Club are now in the past. There was a big concern when it first came out, the stock fell like a rock, and people saying, oh my gosh, it's terrible, they lost their biggest customer, and so forth. That is now behind us, and what we were reading, I was telling people, no, this is actually kind of a good thing. Their earnings actually going up. They did a great deal with Walmart. They still have Sam's Club. So again, that was not the issue it was, and that's why we spend so much time reading and don't panic over the short term because we understand these businesses. Synchrony Home, Car Care, and Care Credit continue to expand. I was so excited. I went to this furniture store. I bought these two beautiful chairs, and I always ask, do you have like 6 months, 12 months, same as cash? They go, yes, we do. I got to fill an application. Oh, okay, sure. They hand me the application. I go, oh, great. Oh, wow, Synchrony Financial. I was so excited. So we live that. So I do have stuff with Synchrony Financial as well. They grew their deposits $7.5 billion or 13% year over year, and now accounts for 75% of their funding. If you need a liquid account, what is their rate now? 2.2, 2.4?
Yeah, about 2.25.
Yeah, about 2.25%. Great rate on liquid money, about the same you get on a CD. And what is nice is that Synchrony Financial, they will pay you 2.25%, which is a pretty good rate. But the rates they're loaning out at are 14, 15, maybe 18% sometimes. That's why this is a phenomenal company. And then lastly, 37% of retail card sales were online. So people saying, oh, it's an old company and so forth. No, 37% of their sales are actually online on the retail card.
Yeah, and it's a big benefit because, again, it doesn't matter where you're shopping. Synchrony can be there. And I really like the home care, the car care. Those have really expanded a lot. Synchrony Home is now accepted in 1 million locations. Car care is now at 500,000 locations. So the use of their credit cards are just phenomenal. Other things, of course, we talked about the valuation. We talked about the earnings growth. Again, we lost Walmart as a client. Oh, my gosh, what's that mean? Well, heck, it means December 2020, GAAP EPS of $4.69. They've done a phenomenal job growing earnings, and they're still very, very reasonable on valuations because that gives us a target sale price of $77.39. Now, some concerns about Synchrony. They aren't perfect, but they're close. One thing was the recent acquisition of Pets Best Insurance business. Now, their Care Credit, I love that they offer the Care Credit at veterinarians because pets are a good business to be in right now. A lot of people spend money on their pets. The reason I don't like this acquisition is Synchrony is not in the business of insurance. They're in the business of deposits and lending money. I don't like when companies get into a different type of business that they're not accustomed to. Now, this is a very, very small part of their business, so it's not going to be detrimental, but it's something we're keeping an eye on. We don't want to see them start to expand heavily into insurance. That's not what they do. Other concern about Synchrony, the 30-plus delinquency rates were 4.92% versus 4.52% last year. So we saw a slight increase in delinquency rates, which means some people have not been paying on their credit cards. But this is kind of a headline number. You had to look closer at it. What happens is they had to put their portfolio for Walmart, it's about a $7-8 billion portfolio of credit lending, onto a asset called held for sale. Now what they had to do was they had to keep $700 million of assets that are going to be charged off due to poor lending, and that's a very, very small amount, so we're all right with that. But that $700 million maintained on their balance sheet, so this delinquency rate is kind of pseudo, because that charge-off, those of course are people that are not making the payment, so it increased it because they got rid of about, again, call it $6.3 billion of good assets and had to keep $700 million of bad assets from the Walmart deal.
Okay, next on the list is PACCAR. PACCAR, we own about 171,000 shares, about $12 million in the portfolio. Their stock price change of 24.9% year to date. Current stock price around $70.23. They were founded back in 1905, and this is a company we're just so excited about. If you don't recognize the name, if you ever see on the road Peterbilt trucks or Kenworth, there was a song, Kenworth Hauling Logs, by somebody that I remember, a country song and so forth. It's just a great brand name. There's so many great things about this company. And again, this should be a record company because everything they do is a record. Record revenue of $6.49 billion, along with record global truck deliveries of 51,500 trucks. That was phenomenal. Parts, because that's the other thing too, like we talked about Apple with the continuous sales. Well, with a truck, you sell these trucks. Guess what you sell after that? You sell the parts. Well, parts achieved record quarterly revenues of $1 billion in the first quarter, 7% higher than the $939.9 million in the same period last year. A new 250,000 square foot parts facility will open in 2020 in Las Vegas, Nevada. I'm thinking we should all go out there and visit our warehouse there. What do you think? You want to join me? Come out and see a warehouse?
Are you paying for it? Free trip on Brent, right? Yeah.
Woo! Moving along. PACCAR Financial Services. That's the other thing too. So they build the trucks, they have the parts, then they finance them for people. PACCAR Financial Services, with a portfolio of 202,000 trucks and trailers, produced pre-tax income of $84 million, which was 24% higher than $67.5 million 1 year ago. And then truck prices increased 2.3% in the first quarter over last year. And in Europe, DAF, which is the Europe brand, now has a record market share of 17.1%. Just all phenomenal news.
Yeah, I mean, the DAF brand was actually won Truck of the Year. So, I mean, it's a phenomenal truck. And, I mean, they're working on different types of powertrains. They're working on hydrogen cell fuel-based.
Electric trucks, everything, yeah.
Electric. They're working on autonomous trucks. This is a very innovative company. They were actually at, gosh, I'm blanking on the name, but a big technology festival. You wouldn't think PACCAR would be at a technology festival, but they were because, again, they're doing phenomenal
I think it's the SES in Vegas. It's the technology conference in Vegas. Yeah.
But moving on, one thing we love about PACCAR is that dividend. I mean, they pay a lovely dividend. PACCAR has increased its quarterly dividend on average 11% per year for the last 20 years and increased it 14% in the first quarter of 2019. Now, the increases go back 20 years, but if we look at how long PACCAR has paid a dividend, it's been since 1941. This is a phenomenal company. They even made money during 2008, 2009. It's just a phenomenal business that we love to have in the portfolio. Only concern about it is rising interest rates could slow down truck sales. I don't believe interest rates are going to pop up dramatically over the next year or so, but it could be a potential headwind to look out for. But the CEO from PACCAR did say trucking backlog demand is still very, very strong, very confident in this year's numbers. Don't think there's going to be a big sell-off next year either.
In case you can't tell, we love PACCAR.
Next company on the list, we have a Nucor Corporation. Number of shares on the portfolio, about 208,000. Stock price change, 2019 up about 9.6%. Current stock price here, $55.20. What do we like about Nucor? Have announced 10 significant growth projects with 6 expected to begin operations this year. Now those expansions are very beneficial. They're helping with cost structure. They're helping with new rebar steel coming onto the market. Plus, it's also increasing their value-added steel. So they sell to like the automotive industry. The automotive industry comes with higher margins because, again, it's value-added steel. So these are very significant projects. I believe the other 4 are going to be finished by 2021 or 2022 as well. So they've done a great job investing in the future of the business. One reason we love Nucor. Speaking about cash from operations, Q1 was $651 million, even after $300 million contribution to profit sharing for the employees. So very good cash flow. Last year, for example, I think their cash flow was about $128 million. So big increase in cash from operations. Very excited about that. One thing I forgot to mention too on the growth projects, the CEO did say, speaking about the economy, how beneficial it is, it'll create 1,500 direct jobs plus 7,500 indirect jobs. That's just from one company. Love to see that economy expanding. And then the other thing we like about it here, stable or improving demand in 21 of 24 end-use markets. Nucor sells to a ton of different end-use markets, and again, large majority of them are seeing very good demand. The ones that are struggling is automotive supplies, and then power generation. And then finally, the largest source of demand is non-residential construction, which is set for another solid year, and we keep talking about an infrastructure bill. Now, we kind of joked around last time at the Klein event about how there's not frequently a lot of agreement in Washington, but the infrastructure bill is one area that both sides want to work on to have come to a conclusion, which would really, again, continue to benefit Nucor and its non-residential construction market.
Also, a growing share in a shrinking automotive market. So while the market share is increasing for them, yes, the automotive market is slowing down a little bit, but they're taking more. And actually, December 2020 GAAP, which stands for Generally Accepted Accounting Principles, we look at the absolute bottom line, EPS of $5.58 gives us a target sell price of $92.07. And also, too, what we like about Nucor is they have a unique way of actually doing the steel. Their costs are much lower. I don't want to get into details of it. I think we maybe talked about it last time, but it's just, that's why we like them much better like a U.S. Steel.
Yeah, they don't have these big blast furnaces. They don't have to really go in and actually manufacture that steel. It's a lot more efficient. And it's one reason that even though steel prices have struggled for the past several years, Nucor has actually been able to expand their earnings because they take scrap metal, which is, again, far more profitable. They've been a very, very efficient company and a very good steward of capital for shareholders.
And actually, Chase is going to go to a Nucor steel manufacturing plant. He's going to also pay for you to go to that one so you can see the actual production of steel, right?
Just let me know if you want to go. We'll take it there.
Concerns we have about Nucor, it is part of a very cyclical cycle because steel does go up and down and so forth, but that's the only concern we can have on the company. We do think it's a very good long-term hold in the portfolio.
Next up, we have Allstate Corporation. Current market value at Wilson Asset Management about $14.3 million, so it is a good-sized holding for us. We love Allstate. Current stock price change in 2019 up 18.8%, with a current stock price of about $96.25. Now, what do we like about Allstate? Premiums have increased across the board. You know, they have the automotive, the home, and another business I'll get into as well. They're seeing premiums increase in those businesses, which is phenomenal, as it was instrumental in seeing consolidated revenues increase by 12.5% to $10.9 billion. That's pretty good for an insurance company to increase revenue at 12.5%. It wasn't just revenue that increased. Net income jumped to $1.26 billion, with earnings per share coming in at $3.74 compared to $2.71 in the 2018 first quarter. So huge earnings growth. Allstate's doing a great job with its costs and also increasing its sales. And then one reason their sales have increased so well, total policies in force have increased by 44% to 123 million policies from 85 million last year. I mean, that is great that they're able to generate that type of demand for their policies. One reason that their policies in force has increased so drastically is because of their new business, SquareTrade. We've talked about that from time to time, but they actually sell protection contracts. So for your electronics and your phones, your tablets, things like that, that increased 86.3% over the prior year quarter. And while this business is small at this time, it is growing rapidly, and it was a great acquisition from Allstate.
One thing very important for an insurance company is their portfolio. Their investment portfolio increased to $84 billion from $81 billion for the quarter. This helped with shareholders' equity, which also increased by $2 billion to $23.48 billion. So that's very important to have the shareholders' equity and the portfolio. What we're concerned about the company? Well, the company has done a great job lowering their exposure to fixed income market, which now makes up about 69% of the portfolio, and that's low in the industry, so they're doing all the right things. But interest rate risk is still there. If rates go up, their portfolio is going to get hurt. But one thing that I did like too is they did talk about perhaps getting out of the annuity sales business. And the reason why, they said, because with the bonds, this is why we do not like annuities. Because what they're doing is they're having bonds in their portfolio to try to match that current income coming out. Allstate says that is not the right thing to do. These are long-term liabilities. They should be doing all equities. But when they do all equities, they're required to put more capital into them. But they're saying, if we can't do it right, we're not going to do it at all. And so they may be getting out of the annuity business. And that's why if you have annuities, you really need to see what they're investing into, because they should be with equities. And again, Allstate said equities are the best long-term investments. And where are we invested? Equities, yes, because they are the best long-term investments. So it kind of proves that there. The other thing, too, I thought was interesting on Allstate was they're talking about the cost of automotive, because their automotive sales are doing very well as far as getting policies on the cars and so forth. They said there is a little problem that they're kind of having. And what that is that now with the cost of parts, because they're so high-tech, that the cost of parts greatly exceed the cost of a car. So what they're actually doing is they're putting cars at a total loss much quicker, because like the price of a headlight used to be like $25. Now they're so high-tech, they're like 10 times at $250 for headlights. So it is an interesting problem, but they have managed to, as Chase showed you, increase their premiums to cover that and do very well. All right, Valero Energy, a number of shares, about 187,000 shares. We own about $15.9 million of this company. Year to date, up 17.6%. I do believe this is probably the oldest company we have in our portfolio. I'd say it's going to be at least 10 to 11 years we've had this company. We love this company. They were founded back in 1980. They were headquartered in San Antonio, Texas. Renewable diesel segment continued to expand. Sales volumes averaged 790,000 gallons per day in Q1. So they're not just doing the same old thing. They're doing other things. And this is what we call research and development. They're coming up with other ways to expand. So it's not just a dirty old oil company using renewable diesel.
I mean, it's actually phenomenal what renewable diesel is. And it's not like you have to have a renewable diesel engine. The renewable diesel can be used in all diesel engines. And what it is right now their mix for renewable diesel is about a third corn oil, a third used cooking oil, and then a third beef tallow or beef fat. And they've actually expanded drastically. It's called the new Diamond deal, and that's been phenomenal. They've increased that, and they're even expanding it further to take on about 400 million gallons of extra capacity for renewable diesel, and they have a great partnership with a company that produces 10% of the global supply of beef tallow, or fat. And so they're able to, again, use that as a source, and I think it's great that they aren't just, again, saying, oh, we're just doing oil. They do have other areas where they can expand in.
I mean, that's why we love what we're doing, because we get to read about these companies and so interesting things that we talk about. Also, do a nice dividend now, 4.3%, and the payout ratio, they only use 50% of their earnings to pay that out. What we also love about this is that for people who got this stock back in, about 10 years ago, their dividend yield is not 4.3%. It's probably closer to 16 or 17% yield. That's, again, why we love to own businesses that pay dividends, because they do increase them. If you're in the bank, they'll never increase the yield, or not by very much. CEO, we've been clear all along that we weren't going to leverage the balance sheet to do share repurchases. Debt to equity, 47.5%. What that tells you is that the CEO is concerned about the business. He is not trying to generate craziness like Elon Musk does. We'll kind of pick on him a little bit. They are concerned about their shareholders. And also, too, possesses record volume of North American sweet crude oil and a record amount of Canadian heavy crude. They're doing a lot of good things, and the business is just growing phenomenal.
And the reason that's important is because they have the ability to be very flexible with the inputs that are going into the refining process. So there are different types of oil. It's not just one type of oil, and they have the ability to kind of alter which oil goes into the refining process, because they've done a great job investing in their capacity. Speaking about supply and demand of gasoline, right now gasoline and distillate inventories are below their 5-year averages, so there's less of a supply out there. Plus, we're hitting peak driving season for the summertime. Now, as a consumer, that means we're going to have higher gas prices, most likely. Don't like to see that. Good thing we have Valero in the portfolio, though, because that means they will benefit from an increased margin. So we got you covered. Don't worry about those increasing gas prices. And then lastly here, December 2020 GAAP earnings per share of $11.26 gives us a target sell price of $185.79. So still a lot of value in Valero. Only concern here, energy sector and commodity prices continue to be volatile. I mean, if you look at the oil market, it's up one day, down another day. You got OPEC doing this, OPEC doing that, Trump saying this, Trump saying that. Oil prices are moving all over the place. But again, Valero is a very sound business that is, again, flexible, which can, again, produce good long-term results for us as shareholders. Next up is my favorite company for obvious reasons, JP Morgan Chase. Great business. It's a bank, as we know. Number of shares owned, 150,978. Market value, I think this is our largest company at the time.
Yes, it is.
Market value-wise at $16.9 million. Stock price change up about 17.6% with a current price of $111.85. Now, what do we like about JP Morgan other than just the name? The net income was a record of $9.2 billion for the quarter, which was an increase of 5%. And they also had record revenue of $29.9 billion. They're doing phenomenal things. They've had a benefit with the slight increase in interest rates over the last couple of years, but the lending is still very, very in high demand, which is great for JP Morgan. The company also continues to execute on their expansion plan, announcing 90 new branches this year, so they are going into different areas across the country and implementing new branches. And then also $55 billion of credit for consumers. This was alluding to here. Demand is very high for loans in the first quarter, and the bank is seeing strong credit performance with net charge-offs of only 2 basis points. We again know that a bank is not going to make 100% efficiency in loans. It's just not possible. You're going to have people that are going to default on those. So to see a low charge-off rate of only 2 basis points is phenomenal.
And the other thing, too, that we like about reading this bank and seeing this is people are kind of concerned, oh, the economy's going to falter, things aren't going to go well. You read what the bank does, they're not concerned at all. Jamie Dimon, the CEO, he's just like, wow, things are fantastic.
Yeah, and one thing, too, that we were looking at is the bank is looking at getting out of the home mortgage business. Might sound like a negative, but if you look at it closer, there's 3,000 federal and state origination and servicing requirements, so it's very heavily regulated, and it's becoming unprofitable for the bank. The mortgage business only had revenue of $1.3 billion, and it's just a small part of the quarterly revenue for the company. But again, that's why we like to own business. If they see something that's unprofitable, we're just not going to do that anymore. They might sell that business off, and again, generate some profit from that as well.
Expenses of $16.4 billion, up 2% as the company continues to invest in technology, real estate, marketing, front office, all these great things. This was slightly offset by reduction in FDIC fees of a little over $200 million. So things are going very well in that respect. And people say, well, gee, but is it expenses are going up? That's not a good thing. No, it is a good thing because they're reinvesting back into the business. Concerns about JPM? We have no concerns on this company at this point in time. So we love this company, not just because it has the name Chase to it, because fundamentally it's very strong. And they have assets of about $1 trillion. I mean, it is the largest bank. I suppose you want to say one thing could be bad. Maybe somebody wants to break them up, but I hope that doesn't happen because they're just run phenomenally well and a great CEO.
And we got some news yesterday that they are actually acquiring a company called InMed, which is a medical processing company. And I kind of talked about Synchrony getting out of its realm. It's processing transactions, which is exactly what JP Morgan does, and it's in the health business. Right now, about 90% of medical services is still on paper billing. This InMed company provides that infrastructure so that you don't have to use paper billing anymore. It's just a great company. It was our largest acquisition in years, and I think it's going to be very, very beneficial. I think by 2022 is the estimation that there'll be about $6 trillion worth of medical spending. That's a heck of a lot of medical payments that JP Morgan can actually be a part of.
All right, next is a company that we also held for quite a long time, and we've added to it many, many times. We own about 290,000 shares. About 13.3 million. Unfortunately, it's only up year-to-date 0.1%. They just reported earnings and kind of had the stock fall down. We're going to explain more about that. Intel is taking a cautious view of the year, although they expect market conditions to improve in the second half. So they're doing some things that are costing them money. They are looking for improvement in the second half of the year. They did generate, during a bad time, $5 billion of cash in the first quarter, also paid dividends of $1.4 billion, and repurchased 49 million shares for $2.5 billion. The company spent $3.3 billion on research and development just in one quarter alone. And if you're spending that much money on R&D, you are going to be expanding and doing better because you're finding a lot of new things to kind of work on.
Speaking of research and development, they did actually get out of the 5G smartphone modem business because it was apparent it would not be profitable for Intel. They said, you know what, Qualcomm, you guys are better than us at this. You go ahead and do that part of the business. We're going to focus our expenses on something that are going to be more profitable for us longer term, which is the base station segment of 5G. And Intel expects to grow to 40% market share by 2022. So just because they're not going to be in the phone modems, they can still be big benefactors from the 5G market. And then just a concern about Intel. The CEO, he's too honest. It's a problem, right?
He's a CFO.
He was a CFO, so he's very stuck on the numbers. You can see CEO Bob Swan is overly cautious with his earning guidance going forward. Quite the opposite of Elon Musk from Tesla, who comes out and says, oh, we had a bad quarter, but next quarter we will sell 8 billion vehicles. I'm being, of course, facetious here, but Bob Swan is very, very cautious in his guidance, which I think is a great opportunity to jump in and buy more of the stock because they are going to have, again, a great future. They're a great business, and I think it presented a great buying opportunity with his reduced guidance.
And I think that's happened the last 3 or 4 quarters where they report good numbers, but if stock goes down because of bad future guidance, we step in and buy more. Stock goes up, next quarter comes up. So again, we like actually seeing that, but I do like the honesty of the CFO as opposed to Elon Musk where he's just a hype guy.
All right, next up is a potential company we're looking at. We haven't done this in a while, but with the sale of Apple, we are looking at other businesses. Doesn't necessarily mean we're going to buy Mohawk, but it is something we're intrigued in. So again, as I said, it's a potential buy. Stock price change so far this year about 19%. Current stock price is $140.49. They did reach a high of close to $300 a share here a couple years ago, so by no means are we buying this company at the peak. What does Mohawk do, kind of first of all? They are a flooring company, so they do carpet, they do hardwood floors, they do vinyl flooring, they do all that good stuff for the home. And speaking of that, what do we like about it? There's a record amount in home equity that now stands at over $15.5 trillion as homeowners stay in their homes longer. Now, if you're staying in your home longer, that means it's going to be worn down. You're going to need to replace the carpet. You're going to need to replace the flooring. So we like this as an opportunity. Plus, you can use your equity in your home to, again, improve the inside, which is flooring. Another thing, too, speaking of my generation, millennials are beginning to buy homes finally, but they are generally older homes that come at a better price point. So again, this is part of the market where they are in need to fix up those homes, improve the flooring. Looking at how the U.S. flooring market is segmented by end-use market, there's about 58% residential replacement, 26% is in commercial real estate, and 16% is new builders. So Mohawk is not just in the replacement market, they're not just in the residential market, they do sell to commercial companies, to individual consumers as well.
And that's one thing we do like is when a company is diversified, not like it being all new homes, because if new homes slow down, that could hurt them. So we like the diversity of that.
Yeah, and then speaking of diversity, one thing too is they actually operate in different markets like New Zealand, Australia. Interesting fact, Australia hasn't had a recession in 27 years, I believe.
No, 28 years.
27, 28 years. Yeah. So they have a good economy there. It's a safe economy. And then also they are in Russia. Russia only makes up about 3% of their sales, but we don't have many companies that have exposure in those markets. So we, again, kind of get a different side of the coin by investing in Mohawk.
And I'm glad you brought up the 28 years for 27 years for Australia, because right now people are saying, oh my gosh, it's been 10 years, United States not a recession, one has to come. No, there is no time commitment that you have to have a recession. The economy's doing well, it can do well. Again, 27, 28 years, Australia, no recession. I think we have at least what I can see another 2-3 years before I do not see a potential recession. December 2020 GAAP earnings of $11.89 gives a target sell price of $196.19. If you notice, not anywhere near, what was the peak, 280 I think the peak was or something? Yeah, so we like to buy businesses when they've been beaten up and so forth, and what we're looking at is what value can we get from this company? We like it, but we just got to make sure we understand it completely. Concerns we do have, restructuring costs of $35 million in Q1. Costs will likely continue to occur. Now that's a negative, but it can also be a positive. We just have to kind of understand how long it's going to go on. We may jump in the middle. We always talk about we'll never buy a business at the absolute bottom, but we try the best we can to get a very good price on that. Inventory grew over 14%, while sales increased just over 1% compared to last year. This is a problem, but it's also a positive, because when a company has a lot of inventory, they have to write down the prices. It hurts them. But eventually that inventory is gone, and then they're doing fine. This actually happened to Valero many years ago when I bought it. That's why I jumped in at that point in time. So I like the high inventory. It could hurt the stock price in the short term, but again, being long-term investors for 3 to 5 years.
I did want to point out too, with the restructuring costs, I mean, generally it's a great opportunity if the business takes advantage of the restructuring. I mean, they're looking at lowering costs, they're improving efficiencies by, closing underperforming warehouses, they're streamlining the business. company that I bought a couple years ago that was going through restructuring was Best Buy. And it was a phenomenal company to buy. I have a good feeling about Mohawk and how they're actually implementing their restructuring. And also the inventory, they created 2 new warehouses. So a lot of that inventory build was you can't have a warehouse and then put no inventory into there. So they weren't selling out on those warehouses yet, but they had to put inventory into there. That should be beneficial to them over the next couple of years because now they're going to start selling more of that inventory. And the CEO came out and said, we are going to match demand with supply, which is always a good thing to try and strive for.
And lastly, input costs weighed heavily on North American flooring segment. So these are things you understand about the business. We know when you're investing, you are taking a risk. We try to reduce that risk and understand what are we getting compensated for that risk. And again, we're not buying this as a short-term trade for 3 months, 6 months, or even 12 months. We buy these businesses for 3 to 5 years. We like this, but we want to be confident because we have about one more buy to buy, and then we use our cash. I think we got about $27 million in cash right now, I think. Yeah.
And I wanted to point out, too, one thing we love about buying businesses, we learn a lot when we're looking at the business. Anybody want to take a guess what the highest input cost is for a carpet?
How about cotton? Let's find out.
Cotton? Petroleum is actually the biggest input cost for making carpet. I didn't know about that. So
yeah,
that's one of the things that they said, and the CEO came out and said, you know, Q1 we had what we believe a peak in input costs. It should be reduced. But guess what they did in Q1? They increased the prices of their flooring. So if you have an increase to cover the inflation of the input costs, and then you have a decrease in the input costs, now you have a nicer margin going forward. So I think Mohawk could be a great company to keep an eye on here.
All right, we went over by about 5 minutes here. We do have for you, as always, the questionnaires, the surveys. We always like to hear back from you, anything that we can do and that you see could be better or whatever. Please fill it in. That's pretty much it. So what we'll do is we'll open up for a few questions. Again, we're a few minutes over. What's that?
Oh, no, nothing.
Okay. So we'll take a few questions. Yes?
You mentioned Best Buy.
The question is, we mentioned Best Buy. What do we think about Best Buy? Well, we've got about maybe 5 or 6 companies that we're looking at pretty closely we like. Best Buy is one of them. Chase really likes Best Buy a lot. So in the office, he's saying, come on, Dad, let's move. And I'm saying, I don't know.
I'm not pushing that hard just yet, but I think Best Buy is a good company. They could benefit from 5G. They do appliances as well. We talk about that home equity, so they do sell home appliances. I think Best Buy could be very intriguing, and it's one we have an eye on, just like Mohawk.
Yes? How is Precision Drilling doing? They have been one of our major disappointments. Oil prices are up. They have done better, but they just can't seem to get out of their way. So we probably will release Precision Drilling this year because we just don't see them turn around. They had profits this quarter, but it's not a loved company, and I think it's time for us to probably say goodbye to Precision Drilling. We're trying to find the right time to take care of that one. Yes?
PE ratio, I'm going off the top of my head here. I believe it was about 12.8.
Yeah.
Or 11. It was 11.8 or 12.8. I know it was 0.8.
I think it's 11.8 because it was 12.8. I don't think we'd buy it.
Yeah. I think you're right.
And you know, it's funny. We started looking at it. We want to get it below 130. We started looking at it now. It's at 140. So we might have to be a little patient on that to get it at that 12.8.
Yeah.
Yes. Sure. Would I comment on Goodyear? Goodyear has been another disappointment for us, unfortunately. They have really been hurt quite a bit, and they had great earnings. They had good earnings about a month ago. They came out, the stock went up, and then the problems with the trade, the oil, they've been hurt again. We constantly look at Goodyear. We've held it now for about 2 years. It's really one of those companies that just frustrates the hell out of me, and I can't put any better than that, and I'm so afraid of getting out of it, because it has the fundamentals are there, and it has the potential to go up, but it doesn't do that. So look at the numbers on Monday, like we do every Monday. It could be gone on Monday. If I see something bad from them with all this, I might say, okay, let's get out of Goodyear and move on. But it's just been a frustrating business because I loved Goodyear.
The valuation on it is just, it's mind-boggling. I mean, if you look at the tangible assets of the company, they now trade below the tangible assets on the balance sheet. and they're producing income. It's not like you have assets that are losing you money. Their assets are generating a good profit. To trade under tangible book value is just, it doesn't make much sense. And they are seeing, again, a decline in earnings due to oil, but they should have trough earnings here, and they should be able to build back up over the next couple of years to return to a growth on earnings per share. So, I mean, we like Goodyear. It's just been a loved company, but a hated stock.
Yeah. And that happens, unfortunately. That's why I tell people I'm probably wrong a third of the time. But again, if we're right 2/3, we still make money in the portfolio. But I'm trying to be perfect. And I tell my fiance all the time I'm perfect, and she kind of laughs at me. You know. All right, we'll take one more question. Yes. Where did Mohawk do what? Oh, where's Mohawk?
I know one was put in Florida, and Florida and Georgia, yeah. I know they're here in the United States, though, so they are putting the warehouses here. They do have exposure out here already, so they were kind of starting to infiltrate or trying to get into different markets as well.
All right, well, that's going to wrap it up. We don't want to keep you too long. We will stay around for questions, so we didn't get to your questions. Please come up. We'll answer your questions. Thank you for coming. We'll see you again in August, and thank you again for being a client. We really appreciate it.